Hey, it's Tom here and welcome back to the channel. Now, just overnight here in New Zealand time, we got some really positive news out of many of the Chinese regulators. Chinese stocks like Alibaba, Tencent, JD.com, Pinduoduo, they've all been pretty hot topics here on YouTube and in the value investing community for really the past kind of 6 months to almost a year at this point. And I think a lot of people are in general agreement for the most part that these are financially at least really great businesses. Many of them have grown very fast for a long time. They typically earn very high returns on capital, and they still have kind of a long runway for growth in the Chinese economy, which is growing much, much faster than some of the other large global economies like the US. But in contrast to some of those positive things about many of these Chinese companies, there have been some kind of regulatory and political pressures hanging over the top of many of these companies. When you buy into a company like Alibaba, for example, when you buy shares or buy ADRs on a US exchange, you're not necessarily buying shares that give you direct ownership in the Alibaba group like you would with a typical US company, for example. You're actually buying kind of a derivative ownership of Alibaba through an entity in the Cayman Islands, which has kind of legal contracts to the profits from Alibaba's core sort of operating businesses in China. So there's that as kind of part of the equation. There's also been a looming kind of threat of potential delisting from many of the US exchanges because some of these Chinese companies aren't necessarily complying with all of the regulatory requirements for a typical kind of US stock exchange. And we've also had a number of kind of perceived macro risks in these Chinese businesses as well, whether it is China potentially getting involved in the Russia-Ukraine situation, whether it is China and Taiwan, whether it is the Evergrande crisis that was all over YouTube here last year, which is a hugely indebted, massive property developer in China, which has run into some issues and caused kind of some flow-on effects of a downturn in the property market in China. The list kind of goes on and on and on of potential problems investing in these Chinese businesses. And the stock price performance of many of these companies has really followed a steady downward trend over the past year or so as a result of a lot of this news. Now, out of China just overnight, we got a little bit of reprieve, I would say, from a few of these issues. So there was a kind of financial committee meeting held in China yesterday with some pretty significant outcomes. That committee meeting was kind of led by some of the top officials in the CCP over in China, and as a result of some of the things that came out of that meeting, there were kind of a number of press releases out of various kind of Chinese regulatory bodies. So in this video, I want to go through some of the highlights of what kind of came out of those meetings, some of the summary kind of articles that have been written up on Bloomberg we'll have a quick look at, and I'll also look at one or two of the kind of official press releases out of these different Chinese regulatory bodies. And as of recording this video, the market has reacted extremely positively to this news. So if you look up stocks like Tencent or Alibaba or JD.com, I think in all cases we're up north of 20, maybe even pushing 30% as of recording this video. I'll put some screenshots up here of how those stocks closed today in the US market. But the news, was very well received by the market, and I think there are some important kind of updates that I will share in this video. Okay, so firstly, a couple of highlights from a Bloomberg article that kind of summed up a lot of the things that happened or that have happened in the last day or so with the developments in China. And I will leave links to everything covered in this video, whether those are official press releases or the Bloomberg articles. It'll all be linked down in the description if you want to check that out. So firstly, having a look at this Bloomberg article, it said, the meeting offered investors reassurance that a sweeping crackdown on internet companies was nearing its end, and that the government would prevent a disorderly collapse in the property market. China's banking regulator said after the meeting that it would support insurance companies to increase investment in stock markets. The statement signals an adjustment after months in which Chinese capital markets were battered by government policies ranging from a squeeze on financing for property developers to a sweeping regulatory campaign aimed at internet giants like Alibaba Group Holding and Tencent Holdings. The sell-off deepened in recent days as rising energy prices caused by Russia's invasion of Ukraine and a surge in Chinese coronavirus cases called into question Beijing's ability to meet its economic growth target. The Financial Stability and Development Committee meeting concluded that there is a need to boost the economy in the first quarter and promised investors relief on several regulatory fronts. Monetary policy will be proactive in this quarter and new loans will grow appropriately, it added. And a couple of comments from kind of further down in the article around general economic growth in China. Obviously, if you're investing in a business like Alibaba, the kind of annual active customer number for Alibaba is getting very close to basically the equivalent of just the number of people in China that have access to the internet. That's kind of how well penetrated that particular business is. So general economic growth is kind of an important thing to keep an eye on for many of these very large Chinese internet giants. So it goes on to say around kind of economic growth, policymakers said this year's ambitious economic growth target of around 5.5% would be achieved mainly through looser fiscal policy, with officials remaining hawkish about the property market and debt growth. There was a fear that Beijing didn't care much about financial markets, and this meeting shows that that isn't the case. It looks serious, said Chen Long, an economist at Beijing-based consultancy Plenum. But they do have to do things quickly. If nothing happens in the next 1 or 2 weeks, markets will begin to think this is fake. And again, just before we get into some of the press releases from the official kind of Chinese regulatory bodies in a sec, a couple of further kind of bullet points at the bottom of the Bloomberg article on sort of other things that were covered in the financial meeting. And many of these are quite significant kind of changes, I would say, or at least adjustments in philosophy from the CCP and the kind of financial committee. So they said regulation of internet platform companies should be standardized, transparent, and predictable. If you followed Alibaba or Tencent for a period of time, you'll know that they've received some very large fines recently, and there wasn't a whole lot of clarity, I would say, on whether those should be expected to be an ongoing thing or whether they were kind of big one-off fines. They've also had some crackdowns in terms of the some of the kind of business behaviors, e-commerce companies like Alibaba can go out and do. They got fined, for example, for forcing people basically to only choose to sell their product on an Alibaba platform, like a Tmall or a Taobao, and they didn't necessarily give kind of e-commerce business people the opportunity to sell across multiple e-commerce platforms. So there's things like that have been cracked down on, and we really just didn't quite know how long these regulatory crackdowns were kind of going to go on for. So standardized, transparent, and predictable is the quote that has come out of this meeting on that front. It also says financial institutions should consider the big picture and firmly support the development of the real economy. Long-term institutional investors are welcome to increase shareholdings in Chinese companies. Beijing and Hong Kong should strengthen communication over the stability of Hong Kong's financial markets. Continuing economic development is the first priority of the CCP, and the economy should operate in a reasonable range, and the operation of capital markets should remain stable. Okay, so moving now to a couple of the kind of official press releases and things that came out of China following this meeting. The first one is from a news outlet called Xinhua. I'm sure I'm probably mispronouncing that, but this is kind of one of the CCP-owned sort of news outlets. So this effectively is straight from the Chinese Communist Party, straight out of the kind of Chinese regulators. So they've said the Financial Stability and Development Committee under China's State Council held a meeting on Wednesday, urging measures to keep the country's major economic indicators within an appropriate range and maintain stable operation of the capital market. Now, one point that jumped out at me here as someone who owns Alibaba via a US exchange, so I own ADRs listed in the US that own the Cayman Islands entity that own contracts to the profits from Alibaba. So there's been a whole lot of kind of chat around delisting of those Chinese stocks potentially in the US over the past few months, and this is what was mentioned in this recent press release. So it said, on the regulation over US listed Chinese firms, the meeting said that the Chinese and the US regulatory bodies have maintained good communication and made positive progress. The two sides are working on a concrete cooperation plan. The Chinese government will continue to support various enterprises to seek listings in the overseas markets, the meeting said. So still ways to go, I would say, before delisting is completely off the table, but we're certainly heading in the right direction with this recent news. And I will read a couple of sections from one more press release, this time from the China Securities Regulatory Commission, which I guess is kind of like a Chinese equivalent of the SEC. That's how I think about it, at least. But if you view it kind of differently, let me know down in the description below. So from the China Securities Regulatory Commission, or the CSRC, lots of acronyms in the finance world, but is what it is. And I should say this is sort of a translation of a press release that was released not in English. So this is the best translation I can get, but just keep that in mind. Potentially, there's always risk of something being slightly mistranslated and that sort of thing, but here we go. So it says, shortly after the meeting of the Financial Stability and Development Committee under China's State Council, FSDC, on March 16th, the leadership of the CSRC convened to plan measures for implementing the requirements of the FSDC. The CSRC recognizes the meeting as timely and important against the complexity of situations. The meeting places high priority on capital markets by fully addressing market concerns and providing very targeted guidance for actions to be taken. This year, China's national economy continues the pace of recovery. Major economic indicators stay in appropriate ranges as pro-growth policies on all fronts are taking effect. Listed companies report better financial results, further consolidating the foundation of the capital markets. Short-term volatility has not changed and will not change the long-term prospects for sound development of China's capital markets. And right at the bottom of the press release, basically goes on to reinforce, saying moving forward, the CSRC will work out detailed plans for fully implementing the requirements of the FSDC so as to safeguard capital market stability with firm confidence, pragmatic attitude, and effective measures. So there's a fair bit going on here, and quite a lot to process, I would say, with the recent news out of China. But it all to me looks largely positive. It looks like moving forward there's going to be more certainty around potential regulatory crackdowns for the big tech companies in China. It looks like the CCP are kind of supportive of US listed Chinese companies, which I think is great news for the likes of investors in Alibaba and Tencent and JD.com and so on. And it looks like they are loosening things up a little bit in terms of keeping the general economy kind of stable and growing. There are concerns about, in the short term at least, COVID cases kind of rising in China, and there are also concerns around the broader economy with the Russia-Ukraine situation, and also with the property downturn and flow-on effects from the Evergrande crisis late last year as well. So some positive developments for sure. There's, I would say, a lot of talk at this present point in time, and we will have to kind of see what concrete actions come out over the next few weeks or months, but I think we're certainly heading in the right direction here. Now, as an investor in a broad range of businesses, one of which is a Chinese company, I'm always still tending to focus as heavily as I can on just understanding that individual businesses and their particular prospects. But when you invest in companies that are as large as some of these Chinese tech giants are, it really is important, in my view, to pay attention to these kind of broader economic developments as well. So I do hope you enjoyed the video. If you did, please hit like and also hit subscribe. If you've got thoughts on some of the recent developments, definitely drop them down in the comment section below. But that's it from me for this one, and I'll see you in the next video. Cheers.